We're on the PDAC 2025 floor, and I'm here with Ron Bernbaum from PearTree. Ron, how are you today?
I'm well, how are you?
Very good.
Great.
You just put out a petition, PearTree did.
Yes.
What is on the petition? I signed it, I know what it's about, but I want to hear what Ron is going to share with you. Thank you.
So the petition went out on Friday asking for an extension of the mineral exploration tax credit, which is a 15% credit added onto the flow-through regime. It helps in getting transactions done because of the tax value reduces the after-tax cost of ownership. It was set to expire, the exploration tax credit was set to expire on March 31st. Everybody, including PDAC, had been lobbying the government, speaking to them regularly. We thought it would be a good idea to get it out. We asked for 3 different things, but the primary one was the extension of the mineral exploration tax credit. And lo and behold, 2 days later, the minister announces, although I don't quite understand how he has the legislative authority to do it, but anyway, the minister announces an extension for 2 years. So they must have read the petition. We'll take it all for ourselves. We did this. No, everybody was singing from the same songbook. This is important. It has a material impact on the ability to get financing done in a sector that we know is historically always challenged for money in order to do exploration.
Well, I have to say, this is amazing news. Delighted to hear this news. Congratulations. We appreciate what both PearTree.
I'm not sure we congratulations are necessarily in order, but we'll take it. Why not?
Well, we want it to be permanent.
Yes.
So I appreciate that. But 2 years is really appreciated.
It's better than coming into the next quarter without the credit. The flow-through regime that's been around since the late 70s, early 80s is really the only way that junior exploration is financed in Canada. And it's a tax-driven offering. Unfortunately, because the returns in junior exploration are generally not wonderful, in fact, they're pretty dismal, and maybe you don't want to hear that, but there is no real retail investor left in Canada, even on the flow-through. In the format that we got approved from the CRA back in 2007, we basically have individuals who have no interest in making an investment in exploration buy flow-through shares exclusively for the tax value. There's complete buy-in by government. The shares a moment later are donated to charity, and the charity sells on at a discount to market, stripped of tax value. And the result of that is, for example, in critical minerals, I'd say 90% of all the investment in Canada, that is, our clients buy flow-through, donate the shares are immediately sold to institutional investors. Almost all of them are in Australia. The Australians have actually made most of the investments in Canada, more so than Canadian institutions, a lot more so than Canadian institutions. They understand the need for critical minerals. And without the Australians, I don't think we would have had a lot of activity in Canada from whether it's copper or any of the other critical minerals. So the format works, but the greater the amount of the greater the tax value, the greater the tax benefits, the easier it is to get a financing done, because there's a spread between what we can pay for the shares and what they can then be donated and sold at. And the bigger the tax package, the greater that spread and the greater the bridging between what an issuer wants by way of a premium and what a buyer wants on a risk-adjusted basis by way of a discount. So it all works out. But I'm happy to see that they've taken a step to do this. There's still quite a lot of work to be done, but I'm glad this is a good first step at least, an important first step.
So Ron, I have to say, we also agree with you that a great deal of work needs to be done. We test audiences all the time with their understanding of both flow-through and charity flow-through and what we also like to call the structured flow-through model. Very few people understand that. We know you do a great deal of work on education on that. What do you think we need to do to help people understand how to take advantage of the structured flow-through model? Because we see continually the main investors being people who can write checks for $1 million plus, and we have a significant upper middle class here in Canada that I'm sure would take advantage of this if they understood how to do it.
You would think so. The challenge we have is exploration is venture capital at its riskiest. If you look at the venture capital private equity model, right? They make 12 investments, 7 of them they never see anything back. 3 of them they might do all right, and a couple of them are major hits, and that makes up for everything else. If you look at the home of the junior exploration market, the Toronto Stock Exchange Venture Exchange, in the last 10 years, the TSX Venture has lost 64% of its value. We said so in the petition. Moreover, in any 10-year period, it loses about 60% or more. So the retail investor is not going to be keen, no matter what whatever the tax value is. Where the structured or charity flow-through model has filled in the gap is that same retail investor that earns more than $250,000 a year and otherwise wants to either save some tax or give more to charity will buy the flow-through shares purely for their tax value, donated, immediately sold, same day, A to B to C. But the third party buying those shares at a discount, and usually it's a 15 to 20% discount to market, those are smart institutional investors. So the province of Quebec has done a very good job of educating many of their investor base outside of the country. If you're asking what can we do to educate more people, recognizing that there's some tax value in supporting jobs in the north through the flow-through regime, which I can talk a little bit about, but it's really an issue of continuously advancing the discussion with government. And that's both federally and provincially. They're beginning to see it. Kendra Johnson in our office, who has the last year or so has been chairing the mining ministers' conferences, where it's been Minister Wilkinson and his provincial counterparts. There's, I think, finally a recognition that the only way to meet the agenda is for the need for more exploration is through enhanced tax credits and or deductions, more so than direct investment. And so that's the education piece. It's getting government to buy in and expand. And as you saw, that petition was the mineral exploration tax credit, but it was also an expansion of what falls within the definition of flow-through shares, so more activity can be financed in this fashion. It works well for reasons we can talk about more so if you want. But go on. Any other questions?
Well, yeah, actually, Jack Lifton on our team keeps doing these interviews explaining to Trump and team that if they really want critical minerals to stop looking in the Ukraine, stop looking in Greenland, but look to Canada. And he says the only thing that's keeping us from the critical minerals we need is capital. So investing in the charity flow-through model, investing in flow-through to help the exploration is something that we are all very keen to support. And in addition to that, finding other models to help finance these exploration plays, which is, of course, the theme of PDAC 2025, I believe. We are actually doing an event about the war for capital resources.
Right.
Okay, so is there any feedback you would like to give the government or institutions about how they can help make money by using the charity flow-through model?
Well, I think basically the charity flow-through model, bridges a valuation gap. So, for example, in Quebec, which understands tax policy better than any other province and understands tax policy better than the federal government, for the longest time, our clients have been able to buy flow-through shares financing not only critical minerals, but precious metals, where we're paying $1.75 for the shares. That's $1.75 that's being used in direct exploration, then donated and sold for $1. So for the subscriber, they're getting a $1.75 deduction for the exploration expense plus another $1 because they gave away the shares and they're entitled to a donation tax credit. When you add all that up, you end up with a reduced cost of giving down to a single digit. But moreover, it's that $1.75 deduction, say in Montreal, results in a $1.75 of economic activity, largely jobs in the Abitibi. I mean, it's holistically perfectly aligned. For the institutional investor to understand this, or better still, that they should understand that they can negotiate a transaction with an issuer where some or even much of that tax arbitrage ends up as a discount to risk adjust the investment in what is otherwise venture capital. And so, yeah, we can. I mean, the model is remarkably robust and very fast. Can I give you one quick example or no?
Yeah, we would love that. Yeah.
So in the 2022 budget, federal budget, there was the introduction of the critical mineral exploration tax credit, which was basically of the 34 critical minerals, I think about 13 of them are on that list, including lithium and copper, say. The budget was extremely clear, and that is if an issuer is exploring for, say, copper, that issuer would be entitled to, or the flow-through subscriber would be entitled to not only a deduction, but a full 30% tax credit against federal taxes otherwise owing. Because of the certainty in the budget, we could rely on that certainty, and within about 45 days, we had completed our first transaction for, I think, $20 million. In the first 12 months, we did $225 million of critical mineral exploration financings. More broadly, across Canada, the number was $350 million. That's remarkable in terms of the speed of deployment. If you thought of the alternative, had the federal government said, we're going to set up a crown corporation, we're going to fund it with $500 million, a year later, they'd still be looking to wonder, they'd be staffing up, they'd be looking for where they're going to rent space, and they'd still be designing their letterhead. Right? Within a month, literally slightly over a month, first money in the ground, within a year, $350 million deployed. Much of it bought by Australians once removed through the charity approach. So, there's nothing faster to deploy capital. We've been knocking on Ontario's doors for a long time. There's a 5% provincial credit in Ontario. It does nothing. The people who buy flow-through shares in Canada are generally those who earn more than $250,000 a year. And, on the CRA website, there is lots of data supplied by StatsCan about where those folks are. Ontario and Quebec finance about the same amount every year in flow-through, except that in Ontario, we have 2.5 times more people earning over $250,000. Right, our $400 million in Ontario, or $350 Ontario, should be $900 million if Ontario adopts the same kind of regime as Quebec. Quebec gets it, they're smart about it, and they prosper as a result of it. And it should be adopted both federally, their approaches should be adopted both federally and provincially.
So what do we need to do in Ontario, Ron, to catch up?
Convince the Department of, let me change that. It's not the mining minister, it's not George Perry, he gets it, he understands it. The impediment is in the Department of Finance in Ontario. And that's just a matter of continuously talking to the politicians, talking about how the value is, showing what that value is, demonstrating it. The numbers are all there. And then getting over the impediment of an Ontario ministry that is dead set against all tax credits, and especially the boutique tax credits, which they lump in the flow-through regime. Mistakenly and to our detriment, to our significant detriment. I mean, to the extent of hundreds of millions of dollars of jobs in Ontario's north, simply not created because of government lack of understanding the policy.
Okay.
Can't be too strong about that.
Global education. The Australians get it. What about the Americans?
So, in this, in the charity flow-through model, our subscribers buy the shares, donate the shares, are immediately sold, and about 90% of those sales go to non-Canadian institutions, including, as I mentioned, the Australians. But historically, the Americans have bought quite a lot from us over the years. And so there are U.S. funds many U.S. funds that will, and family offices that understand the approach and will be investors very regularly. So the U.S. market, because of the closeness between Canada and the United States, understands. There are more people in the United States that understand this approach than there are in other jurisdictions, including, say, the UK or Australia. But it's a matter of global education. This approach really gives Canada a financing advantage that doesn't exist in any other jurisdiction in the world. I mean, when you look at the fact that an Australian investor institution can put up $1 and then see $1.75 deployed in the ground with a governance package that is mandated by the government of Canada and policed by the CRA. Right? It's astounding. I mean, there's great comfort in knowing that $1 of investment in Australia or the UK or the United States results in as much as $1.75, and in some cases almost $2, depending upon the province and what's being explored for. It's a remarkable leverage, reduction in investor risk, and an expansion in leverage in terms of for every $1, a significant more ends up in the ground. It's amazing.
The takeaway here, this gives Canada a financial advantage. As always, Ron, it's a real pleasure to have you. And for everybody interested in more information, please go to PearTree's website listed below. Thank you for joining us.
Thank you for having me. It's always a pleasure.